So those are your balance sheet statement, or excuse me, balance sheet formulas. And then your income statement formulas are EPS, earnings per share, which is earnings or total income divided by number of shares outstanding. And then the PE ratio, which is the current market price divided by the earnings per share. Okay. So those are kind of the secondary formulas I would have you memorize. Oops. The main ones that you definitely need to know are current yield, which is annual income divided by current market price. Let's put it down here. Okay. And then the other one is, when we'll go over the next one, but total return, which is going to be income plus capital gain or loss, if you had a loss, divided by your cost basis. Okay. So those are all the formulas that you would need to know. Okay. So everybody got those? I'll move on to the next slide. The rest of this slide, so the cash dividend sequence, again, the acronym is DIRP. So it goes declaration date, then X date, then record date, then payable date. Okay. You definitely need to know that. And the two most important ones are the X date and the record date. Okay. So the X date is the date that the stock trades without the dividend. So you need to buy it the day before the X date if you want the dividend. The record date, you must be the holder of record on the stock as of the record date. Okay. Well, you're the holder of record once your stock trade settles. So you need to buy the stock 2 days prior to the record date. Well, the X date and the record date are always right after each other. Okay, it goes X date, then the record date. Because remember, if you want to buy the dividend, you need to buy it 1 day before the X date, which would be 2 days before the record date. Okay. The payable date is literally just the date that the dividend is actually paid to you and posted to your account. All right. And the declaration date is the date that the board gets together and meets and determines, how much is the dividend. Okay. All right, let's move on. Okay, so yield is the measure of the amount of income an investor will get as a percentage of the cost of their investment. So the current yield, which we talked about it in bonds. With the bond, it's the annual income divided by the market price of the bond. With the stock, it's the same thing. It's just annual income divided by the market price of the stock. Okay. So current yield is probably used more frequently with bonds because bonds, you're really concerned about a yield. Whereas stocks, you can buy a stock for the dividend, but generally you buy a stock because you want capital appreciation. Okay. Not necessarily income, but they do pay an income. So you can calculate the income yield from a stock with the current yield. You just take the dividend divided by the market price. So be careful on this. Dividends are generally paid quarterly. So in this case, the annual income is $1 divided by the market price of the stock, 1 divided by 20, so 5%. Okay. You're not going to get very many math questions on the exam, probably 2 to 3 max. All right, but almost guarantee you one of them's current yield, the other one is probably total return. Okay. So let's talk about the other investment returns. So income, we all know what income is, right? It's interest from a bond or dividends from a stock. Well, capital gains is the amount that you make when you buy or sell a stock or a bond. Okay. The difference between what I paid for it and what I sold it for. It has nothing to do with the income generated. So you want to think of them as two separate components. Okay. Income is what I got for the dividend. Capital gain is when I bought it low and I sold it high. So I bought it at 10, sold it for 15. Well, I have a $5 capital gain. Okay. So capital gain is just what you sell it for minus what you bought it for. So sales proceeds minus adjusted cost basis. I don't usually add this as a formula because, hopefully you kind of just intuitively know it, right? If you're selling your house and you're trying to figure, well, how much money did I make off of the gain? Well, if I bought it for 300,000 and I sold it for 400,000, you made 100,000. Okay. So that's your capital gain. Same thing with a stock. It's literally anything you sell. Okay? So we say the adjusted cost basis. Okay, so if I bought a stock for 10, sold it for 15, my cost basis is 10. Adjusted cost basis means that in some scenarios, you may have to adjust the cost basis. And what scenario would that be? That would be if a stock dividend were paid. Okay, so if you remember back when we were going over dividends, cash dividends are taxable when received. A stock dividend is not taxable when it's received. Instead, your cost basis is reduced. So let me give you an example. Okay. You own 10 shares of ABC and you paid $100 total, so $10 per share. Okay. Well, guess what? ABC decided to give you a stock dividend. And so ABC paid you a 2-share stock dividend. So when you got those 2 shares, let's assume the stock was trading at $10 at that time. Well, that's $20 worth of free stock. You don't have to pay $20 in taxes. You don't file any tax return for that, right? It's a stock dividend, so it's not taxable. Instead, the total cost basis of your position is adjusted. Okay. So remember, I paid $100 for the 10 shares, but now I have 12 shares. So my adjusted cost basis would be, let me get my calculator out, 8.33. Okay. I would not anticipate that you need to be able to know how to do this. All right. But you just need to try to understand conceptually, when I get a stock dividend, I'm not paying any taxation, any taxes on the dividend. All right. It's only that the position, the total cost basis per share is adjusted downward. And so then if I go to sell those 12 shares, well, then I would pay taxes. Okay. So hopefully that makes sense.